U.S. stock markets surged on Friday after new inflation data signaled that consumer prices in September rose slightly less than expected, reinforcing investor optimism that the Federal Reserve is nearing the end of its tightening cycle. The U.S. dollar, meanwhile, was little changed as traders weighed the implications for interest rates and global currencies. Cooling inflation fuels market optimism. The latest Consumer Price Index report showed a 0.3% monthly increase in prices during September, compared with forecasts of 0.4%. On a yearly basis, inflation rose 3.0%, a modest improvement from the previous month. Core inflation, which excludes volatile food and energy prices, also eased slightly, a key signal that underlying price pressures are gradually subsiding. The data reinforced the view that inflation is finally stabilizing after more than 2 years of aggressive monetary tightening. It gave markets fresh confidence that the Federal Reserve will begin cutting interest rates soon, possibly as early as its next policy meeting. Wall Street rally gains momentum. The major U.S. stock indexes reacted swiftly to the softer inflation reading. The S&P 500, Dow Jones Industrial Average, and Nasdaq Composite all surged to new highs. Technology and growth-oriented stocks led the rally, as lower inflation improves the outlook for future corporate earnings and borrowing costs. Investors were also buoyed by strong quarterly earnings from major companies, adding to the optimism that the U.S. economy can continue to expand even as inflation cools. The combination of easing inflation and resilient corporate performance created a powerful tailwind for equities heading into the final quarter of the year. Dollar stays flat as yields ease. While stocks climbed, the U.S. dollar index, which measures the currency against a basket of major peers, remained largely unchanged. Treasury yields drifted slightly lower, reflecting expectations that interest rates have peaked. Traders appeared cautious, choosing to wait for further signals from the Federal Reserve before making larger currency bets. The flat performance of the dollar suggests markets are balancing two opposing forces. On one hand, softer inflation points toward rate cuts, which normally weaken the dollar. On the other, steady U.S. growth and global uncertainty continue to support demand for the greenback as a safe haven. Fed policy outlook shifts. The cooler inflation figures prompted analysts to revise their expectations for monetary policy. Many now anticipate that the Federal Reserve will begin easing rates in the coming months, potentially reversing some of the sharp hikes implemented since 2022. However, central bankers remain cautious. Inflation, while moderating, is still above the Fed's long-term 2% target. Officials have indicated they want to see more consistent evidence of price stability before committing to a clear policy shift. Global market implications. A softer U.S. inflation trend and a stable dollar are welcome developments for global markets, especially emerging economies. A steady greenback eases pressure on foreign currencies, reduces import costs, and improves financial conditions across developing regions. For countries like Bangladesh, India, and Indonesia, a calmer dollar environment can help lower inflationary pressures driven by imports and strengthen capital inflows into local markets. Cautious optimism remains. Despite the market enthusiasm, analysts warn that risks remain. Inflation could flare up again if energy prices rise or supply chains tighten. A delayed response from the Fed could also dampen investor confidence. Additionally, ongoing U.S. fiscal uncertainty, including potential government shutdowns, may disrupt future economic data releases. Still, for now, the mood in financial markets is optimistic. Investors see the latest inflation report as confirmation that the worst of the price surge is over and that the U.S. economy is moving toward a more stable growth phase. Stocks have regained momentum, bond yields are easing, and the dollar remains steady, creating a rare moment of balance in global markets. Outlook. If inflation continues to moderate and the Fed signals rate cuts in the months ahead, equities could extend their gains into year-end. Yet, any surprise spike in prices or a more cautious tone from policymakers could quickly reverse sentiment. For investors worldwide, the message is clear: the U.S. inflation picture is improving, and while challenges remain, the path toward lower rates and a softer dollar may finally be taking shape.